Welcome to Taking Stock for the week ending the 29th of July, 2022. I'm Kien, and joining me today is our Senior Equities Analyst, Jason Yin, to stream to you all things share markets. It's great to have you on board, Jason, especially with the reporting season on our doorstep.
Yeah, it's going to be an interesting couple of weeks ahead.
But before we get started, just a reminder that the information provided today is of a generic nature and therefore shouldn't be considered personal advice. Remember, shares are volatile, so any charts and tables presented today should not be relied upon as a guide for future performance. Well, it's been a big week on the economic data front and company announcements as well, and inflation and interest rates remain the recurring theme. And this week, Australia's inflation rate hit 6.1%, but it was below market expectations of around 6.3%. And this helped mitigate the market volatility over the week.
Meanwhile, over in the US, inflation actually hit a 4-decade high at 9.1%. And it was no surprise to see that the US Fed increased the cash rate by 75 basis points to around 2.5%. Despite this, the US market rallied as the US Fed Chairman Jerome Powell alluded to slowing pace in interest rate rises later towards this year. In addition, he also stated that he doesn't believe the economy is in a recession, with many parts of the economy still performing quite well. With around 68% of Q2 results beating market expectations, it seems like that investors are finding a little bit of opportunity across the oversold names.
Yeah, we've seen that across our star growth stock universe, Jace, but economies are slowing down on the back of inflation. And the International Monetary Funds, they did downgrade their outlook for the global economy to slow from 3.2% this year to 2.9% next year. But remember, Warren Buffett, he recently suggested that inflation swindles all asset classes. So cash and bonds are not safe either as well. And from our perspective, the best protection against inflation and the challenging economic conditions is to really focus on profitable, financially healthy businesses. Invest in those high quality companies that have a strong market position and also have continued demand for their goods and services, irrespective of price rises. And the reporting season should provide us with a clearer picture on these opportunities.
Yeah, sage words of wisdom coming from Warren Buffett. Look, this reporting season is going to be an interesting one, especially for the retailers, with consumer purchases quite sensitive to rising interest rates. In Australia, the cash rate is currently 1.35%, and the market is expecting this to move rapidly to around 3.4% by 2023. We've already seen the impact of higher interest rates in the US, with Walmart, the biggest grocer in the US, downgrading earnings as consumer spending has reduced, especially on clothing.
Yeah, that's interesting. And although we've begun to see a price rebound across some of our star stocks in the retail space, we remind investors about the heightened risk with analysts paring back their earnings on stocks like Adairs, for instance, Premier Investments and ArbCorp as well. So just be careful with this space. Also, another sector with heightened risks is the resources, with the final week of the quarterlies providing us with a clearer picture on the fundamentals. So Jace, which were the best and worst performers this week out of the resources?
I think I would probably have to say the lithium producers and star growth stock, IGO, and also borderline star stock South 32. Both of these companies achieved pretty strong results, and this is courtesy of the diversified operations and solid production numbers. However, copper miner Oz Minerals and also tin producer Metal X and iron ore miner Grange Resources, they struggled a little bit with higher costs, including labor shortages from COVID, absenteeism, and also some production issues as well. For Oz Minerals, we've seen that they recently downgraded production guidance as they continue to manage equipment failures in the South Australian assets. With return on invested capital expected to fall significantly in FY22, we don't think the company is likely to be retained as a star growth stock once it releases its results.
Yeah, good point there, Jace. But I've also noticed both Metals X and Grange Resources, they don't have forecast estimates. So investors will really need to rely on our commentary and also the company guidance for visibility into those production numbers. And for other resource stocks, though, investors also need to be cautious in relying on those forecast figures because these are based on long-term commodity price assumptions, which can change quite quickly. For example, with Rio Tinto's recent first half result, 63% of its profit decline was attributed to the fall in iron ore prices.
Yeah, it's an interesting point. I mean, during periods of slower economic growth, we prefer to invest in larger diversified miners with low costs of production, such as your BHPs, your Rio Tintos, and your South 32s. In addition, growth investors may also wish to look at companies like IGO that are reinvesting their profits and back into growth opportunities, also including the recently acquired nickel producer Western Areas.
Yes, but of course, you don't want to be too concentrated in resources as well. And moving from resources to financials, Star Growth Stock and Star Income Stock, Macquarie Group, they delivered an increase in net profit in the June quarter compared to last year on the back of stronger business activity from volatile commodity markets and also rising interest rates. However, the group did warn that trading conditions have begun to soften, and this appears to be reflected in consensus, with return on equity and earnings growth expected to fall in the coming year. But despite the expected decline in earnings, Macquarie's low payout ratio should help provide a margin for dividend payments, which are quite modest, with a forward gross dividend yield currently trading around 4.3%. But with the company reporting out of cycle, this stock is not expected to go ex-dividend until early November.
Another company to report this week was wealth management firm and borderline and also Star Income Stock Perpetual. And the company suffered an 8% decline in assets under management for the June quarter, which was unsurprising given the fact that market performance has been quite weak and net outflows as a result of this. Fortunately, most of the fund outflows were related to the lower margin strategies, such as the fixed income and also cash mandates. But also within the equity space, a higher proportion of their funds were able to outperform the market. And this is due to their bias towards value strategies, which has recovered. Also as well, this should help stem some of the outflows, and also the negative earnings revisions that have occurred over the last 3 months may start to recover if their strategies continue to outperform.
Yes, Jason, the better than expected performance suggests that the forward gross dividend yield of around close to 10% is sustainable. And although the payout ratio is at over 80%, remember that looks high. It's not really unusual for fund managers to pay out most of their earnings to shareholders. Interestingly, though, the company is currently in discussions on the potential acquisition of Pendal Group as well. Although a near-term capital raising is unlikely to occur. We'll continue to monitor this going forward. Now, looking ahead, the start of the reporting season kicks off with Credit Corp, BWP Trust, Pinnacle, and also Genworth Mortgage Insurance releasing their results next week.
Also across to our technical alerts, well, the stocks that have triggered a bullish signal on the SD Max include Arena, AXX, Baby Bunting, Codan, Collins Food, Coles, Hansen Technologies, RDP Education, Pro Medicus, REA Group, and Spark New Zealand. Meanwhile, Baby Bunting, Codan, MFA Financial, Pro Medicus, PWR, and REA triggered a re-entry on the SD30 TSR.
In Under the Microscope this week, we take a closer look at mineral drilling contractor and borderline Star Growth Stock and Star Income Stock DDH1. In brief, the company offers third-party deep hole drilling services to the Australian mineral exploration and mining industries. Its share price has been under pressure over the past couple of months, and this was due to a material downturn in commodity prices, which reduces the demand for drilling services, along with inflationary cost pressures and COVID-related labour constraints.
Positively this week, the company announced its preliminary FY22 results, which actually sparked a bit of life back into the share price. Performance over the last financial year was solid, with revenues up 40%, and this should help the company generate a return on invested capital of above 20%. Importantly, management noted that cost headwinds such as wage expenses and also consumable costs are actually starting to ease. They also expect client demand to proceed with planned drilling programs, which should aid a little bit of their revenues into the next financial year. Although the low analyst coverage of only 3 analysts does lower our confidence around the outlook.
Yes, Jason, and from an income perspective, free cash flow per share appears to be below dividends, but this is really due to a one-off payment for the Swick acquisition. As such, the dividend at around 9% appears quite sustainable once cash flows normalise and grow back in financial year 23. Note that the payout ratio of only about 40% also remains unstretched, with the stock going ex-dividend in mid-September.
Now, DDH is also trading at a steep discount to consensus price targets. This may represent an opportunity for long-term investors, although with only 3 consensus analysts covering the stock and the demand for drill rigs highly dependent on commodity pricing, you should therefore place less emphasis on the current valuation.
And of course, trend-sensitive investors, they should remain on the sidelines until a bullish trend is triggered on either the SD Max or the SD30 TSR. But with the stock oversold and fundamentals still intact, it does look like an opportunity for long-term investors. Reporting season is often a volatile period for stocks, creating opportunity, but also disappointment for investors. So a useful question this week is, how do you manage portfolio risk during the reporting season? First and foremost, you should maintain a diversified portfolio of at least 15 financially healthy stocks and hold some cash on the sidelines to take advantage of oversold opportunities. And you can keep a close eye on these oversold star stocks by running a filter or by referring to our star stock watch list.
Also pay attention to the heightened active risks for each stock in your portfolio as we head into reporting season, and you can achieve this by reading our analyst commentaries. For example, with rising interest rates, you don't want your portfolio to be too concentrated to the retail sector. Likewise, you also don't want too much exposure to resources when commodity prices are rolling over.
And to refer to the 3-month earnings revisions under Golden Rule 3 and price target trends under Golden Rule 4, and this allows you to track consensus analyst sentiment leading into the company result. And for stocks with large negative earnings revisions, it's best to wait for their results before taking exposure.
Take comfort with stocks that have provided updates to the market over the last few months because the risk of a negative surprise over reporting season is somewhat mitigated. These stocks include the resource stocks that have just announced their quarterlies, as well as JB Hi-Fi, Net Wealth, Cogstate, Jumbo Interactive, Pinnacle, Objective Corp, and DDH1.
And depending on your investment approach, you've got to take decisive action. An oversold stock with a promising outlook statement could represent opportunity. And if you are not comfortable with the heightened active risk, then really you should sell the stock. Do not hold on to hope. And if you are trend sensitive, then sell or buy if the stock triggers an exit or an entry on the SD Max or the SD30 TSR. Use our corporate calendar and alert functionalities to monitor results and refer to our commentary for full details.
For income investors, pay attention to the ex-dividend date using the Stock Doctor alerts and watch lists. Although stock prices tend to fall on ex-dividend date, our research has demonstrated that they tend to recover once better than expected results are announced.
Yes, Jace, there's going to be plenty of announcements, so make sure you take advantage of the Stock Doctor tools to help you monitor those stocks in your portfolio. But thanks again, Jace, for your contributions today.
Thanks for having me, Kien.
Well, unfortunately, our Chief Investment Officer, Tim Lincoln, will be unable to join us for Lincoln Live this Monday. However, our Portfolio Manager, Matthew Swartz, our Stock Doctor expert, Rob Manfrey, and myself will be there to answer any questions you have as we head into reporting season. So to summarize, fears of inflation and interest rates appears to have eased, but investors shouldn't be complacent. A slowdown in the economic cycle means you should focus on those financially healthy businesses with strong cash flows and margins, companies that can provide goods and services that continue to be in high demand. Take care and have a happy, healthy, and prosperous week, everyone.